Good morning. 2 minutes to go. We've got to talk about the Fed, but this GDP PCE number is going to be important. While we wait on that, stock futures here up after sliding yesterday. VIX down 8%. Bitcoin up. Overnight data mixed. Most GDPs that were reported were better than expected. Not all. So as we kind of brace for this number here in a minute, some of the stuff out of the EU, slight beats. Bank of England, similar to our Fed yesterday, held rates but was divided. More on that in a minute. Interestingly enough, there were some shots fired overnight, yet Brent and crude are down on the day. Brent back up over 90, but crude sitting at 83. Any second about to drop here. Claims second straight week under 200,000. PCE monthly negative 0.1. Year over year on the screws. GDP came in at 1.5 versus an expected 2.1. Core PCE came in at 0.1 versus an expected 0.2 and a 0.3 from last quarter. Headline 3.3 in line, down versus 3.4. Mixed is what I would call it. Our first reaction is slightly worse. I don't know if that's a reaction to claims. Hard to love these claims. Final sales for Q2 came in at 2.2. Listen, I'm not going to sort of dance a jig over these PCE numbers, but let's create some context. Core quarter over quarter, 4.4, expected 3.5, came in at 3.4. So not only a miss, but a material drop. Headline prices did go up quarter over quarter, 4.651. That's the one thing that you don't love. Last quarter definitely, or I should say last month, revised up 0.4 to 0.5 headline, but expected a negative handle and got a negative handle, negative 0.1. And like I say, the year over year 4.1 down to 3.7 as expected. And then the headline GDP at 1.5. I mean, look, that number is going to move around, but hard to be unhappy with that. We're kind of back to where we were before the number. Just have some housekeeping to do, so hang on. We're going to cover a little bit here. Yesterday we got a head fake from the Fed, so let's talk about that for a second. The market liked the initial tone and tenor. We had a hold. Now, keep in mind, we had a 30% chance, 35, I think it was, of a hike. So in theory, that requires some reprice, right? Because maybe not literally, but an unexpected hold. And 35%, I don't know that you could quite call it unexpected. It was certainly unexpected by about a third of the market, right? An unexpected hold, okay, would have some down channel implications in terms of, okay, we're still pricing in a hike, but does this delay a hike? For the 2 or 3 hike in 26 crew, a hold in July, keep in mind, no meeting in August, okay? Hard to believe there would be an intra-period hike. Really hard to believe, right? So now you're talking September. Are they going to move 50 in September? after holding, not unless the data warrants it, and this recent PCE GDP doesn't, right? So how do you get to 2-3 hikes if we held in July? I don't want to say that you can't, but I do want to say that it's harder to. Let's see where Fed funds are pricing hikes right now. September is sitting at 57. We did have 3 dissenters, by the way. Future markets imply a cumulative expectation of roughly 35 basis points of tightening by the end of 26, right? Futures price changes. So where were we yesterday? I don't remember. I'm going to have to look into that. I want to say we had like a 70% chance of a hike in September. So are the chances of a September hike down slightly, recalibrated lower? I have to look into that. But net, futures are pricing in 35 basis points of hikes. And at one point, I believe the consensus was we were pricing in 50. So I think that's despite the fact that there was some renewed hostility in the Middle East. And I can't explain exactly why oil is down. I mean, you would think it would be up other than maybe just selling fatigue. We do have potentially some month-end trading implications here. Long story short, we are pricing, I think, slightly better because of the hold. 3 dissenters, and it is what it is. As the presser went on, and it's really hard to put a finger on why that might be the case, right? Like, what did he say? And you could read both ways into everything. As the presser went on, we liked it less. The market liked it less. So, but this bounce this morning after us fading into the close is much welcome. I'll tell you something. The thing I don't love is claims. Now, last week was revised up, albeit 1,000. Claims being below 200,000 for 2 straight weeks, I think has to get your curiosity. Totally divergent from the weekly ADP numbers. Weekly ADP keeps getting worse. Claims keep getting better. What the heck is that going to mean for non-farm? We shall see. So how do you trade this? Well, listen, in some respects, I want to say yesterday you dodged a bullet. In other respects, I'm going to say, based on the hold, I'd like to think that we're better off than where we are right this second. I'm a little bit disappointed. We're being propped up a bit by the short end. And as duration on mortgages historically has gotten shorter, we tie more to the short end than we do to 10s, right? So, the fact that the rally in 2s and 5s and such, has been bigger. I mean, you're talking about before the number, we were at 433 on 2s. We're at 425, right? On 10s, before the number, we were at 464. We're at 467. So MBS holding its own more, I think, because of 2s and 5s than certainly 10s. So how do you play this? Well, in some respects, you dodged a bullet. You've got a little bit of a bump this morning if it holds. I reiterate the same thing I've been saying, 6s and 6.5 coupons. So that's 6.25 note rate and higher, which for the most part are your production coupons right now, right? Those are still good value and are holding up, and certainly holding up better than 5s and 5.5. So I think that there's a case to be made for locking, taking the risk off the table and locking it. But I also think there's a case to be made for what we know now about PCE, and the Fed specifically talked about PCE yesterday, right? What we know about PCE and June printing a negative, on a core basis, further, that almost disconnects us in some respect to oil. That's what I like about that. Now, not exactly, right? Because it directly disconnects us from energy. It doesn't indirectly disconnect us from energy. I think that we should be rallying on this GDP. I think that we should be willing to overlook the claims, but I'm putting a pin in that, right? I don't like the last 2 weeks. We were running 220, 230. Now all of a sudden, we've got a 100 handle on it. Don't love that for rates. But with a 1.5 GDP and PCE where it printed, I'm just having a hard time placing 10s at around 470 and us not taking a little bit, of the pressure off of rates. Again, certainly what doesn't help us is this sort of renewed tension in the Middle East. So, there you have it. We talked about how you wouldn't have time to react. If on a early August, mid-August closing, you've got a lot of data coming up, and I think that this claims number should give you pause. I think, by the way, if we printed 220 on claims today, I would be 70% float, right? So the question is, what's going to prevail? That's the if you're going to do a gut check, the question is, if I look at GDP, if I look at this renewed tension after sort of 2, 3, 4 days of thinking we were getting back to peace, if I look at PCE, if I look at where all the data has gone, I have to feel pretty good about it, where interest rates are going to head. And then I look at this outlier of claims, and I don't love it. And because I hate non-farm, I could absolutely see us printing a great for rates ADP number next Wednesday, and I assume it's Wednesday. I don't think they changed the day. It should be, and then a surprise beat on non-farm. We'll see. I said this yesterday, not for the faint of heart. Bulls and Bears make money, pigs get slaughtered. Thanks for joining live, watching on replay. See you guys tomorrow.